All right, welcome back everybody to Blue Sky 7 Continued. This segment is called Research Insights from the 2020-2021 Model Book Winners. And your speakers will be myself with Rain King Insights. And also we have Mike Kinkead, who's part of the Boston IBD meetup. Mike's been a big contributor to the meetup for a very long time in Boston. He's an entrepreneur and he's a real statistician with research. So that makes the research that we did very, very rich. So for you that are, all those that really use the CAN-SLIM methodology, I think you're going to enjoy this core CAN-SLIM type of research. So as again, me and Mike have been collaborating. We've done multiple model books together. We're both veterans of using CAN-SLIM. We're both part-time traders. And I also wanted to recognize Aaron Blank and Victor Rosen and Yulia Costello because they were very special contributors and they did a lot of the data gathering that we used in compiling all this research. Okay, so this is the research study. It's going to be a whole report that will eventually be issued for basically the bull market cycle, the COVID bull market. So the report is over 2,200 pages. There's a lot of different material in it, but today in 1 hour, we're only going to be able to hit some excerpts, but they're very important excerpts. We're going to talk a little bit about the context of the COVID bull market. We'll get into some ONeal CAN-SLIM criteria, and then we're going to share some stuff on a deep dive into green flag analysis. And then we studied the first 8 weeks of the biggest winning stocks. And then we eventually tried to get it to answering the question about easier to trade stocks, harder to trade stocks, and what were the key signposts to manage those trades. So as I mentioned, there's a 200-page report behind all of this, but it's very comprehensive. We've got, I think we have over 80 annotated charts in the report. We've got graphs, summary tables, et cetera, et cetera. We've got so much material in this particular study that we're actually, and we'll share this at the end, we're actually going to do a 3 one-hour webinars to cover all the detail and insights from the report. So we'll give you some information at the end of how you can participate in that. All right, so let's talk about what we actually studied. We really started with a bunch of questions. We asked ourselves questions like, what can we learn from model book stocks that pass the ONeal fundamental and technical criteria? We looked at what criteria can help us identify a model book stock very early in its run. We also looked at questions such as, what's the behavior of green flag stocks? And green flag stocks are defined as stocks that go up 20% or more in 3 weeks or less. And we also were able to look at, how do we look at the stocks in this rally compared to other historical model book comparisons? What was a model book stock's initial run-up? We looked at intermediate pullbacks. We looked at before and after reaching 20% gains. What were those pullbacks like? How did the model book stocks hold the 10-day and the 20 moving averages versus the 50-day moving average? And what was the price to action generally in the first 8 weeks? And then most importantly, we were trying to drive towards, what are the key signposts that we can identify to improve our ability to really hold a true model book stock. So let's cover a little bit on just the context. So as we can recall, it's only 4 years ago, in 2020, we had the COVID crash. Now this is a NASDAQ chart, a line chart. Here's the COVID crash, and we all knew some of the incredible things that were happening at that time. The Fed was cutting rates aggressively, but it was on April 6th that we got the follow-through day on day 11 on the NASDAQ, very powerful 7.3% gain. Then the first 13 weeks following that, in this zone here is where a lot of the big leading stocks broke out. And there were other stocks that broke out later in the move, but the NASDAQ didn't peak until late 2021. Now, the focus of the study, again, was looking for the key signposts. there's 159 stocks that made the biggest gains from breakout to peak. The minimum gain for these stocks was 106% move, and the biggest gain was 1680 maximum move. Now, out of the 159 stocks, 108 of those were green flag stocks. And as I mentioned, if you're an ONeal person who uses Market Surge, green flag stocks gain 20% or more from the breakout in 3 weeks or less. And Market Surge identifies those green flag stocks, and Market Surge uses an intraday and or closing basis, and they show that on the daily and weekly charts. And why we did a deep dive into the green flag stocks is we were looking at Bill's 8-week hold rule. And just to refresh everyone, Bill's 8-week hold rule that he developed was if a stock goes up 20% or more in 3 weeks or less, quote, green flag stock, Bill said you really need to hold that stock for 8 weeks. So that was the context. How did this 8-week hold rule hold up during this particular bull market cycle? Now, there's lots of definitions in the study, a lot of data guidelines. We're not going to go over this in great detail, but it's all included in the study itself. The key definitions that we'll go over in the presentation, we will pause and go over those in detail so you understand the insights. But there's a lot of definitions throughout the research. So growth stock winners, there were a lot of growth stock winners, and there were also cyclical winners in this particular bull market cycle. So this is a chart. Again, this is the NASDAQ on a Market Surge chart. And I'm showing this is where these stocks broke out. Here is the April 6th follow-through day. The green zone is the first 4 weeks post follow-through day, and the yellow is the next 9 weeks after the follow-through day. And you can see, for instance, here we have CrowdStrike, Livongo. Livongo was up 385% to its peak, 5.9, NVIDIA. So this is just showing you the plot of some of the big winning stocks. When they broke out, it's a great reference tool to go back to these charts and really study the action of these big winners. Now, coming back, we just took a quick look at the first 13 weeks that stocks broke out, and you have that data. There were other stocks that broke out before the market actually peaked. You can see here, there's all kinds of other stocks that were breaking out. And gradually, as we got further into late 2020, cyclical stocks started to lead the market and started to break out. And it was really in these first few months of 2021 where there was a lot of rotation from growth stocks into the cyclical stocks. And the study includes those particular big winners that were cyclical stocks. Now, in looking at the study, we looked at one simple analysis that we did. It was we looked at a couple of key metrics relative to how many growth stocks there were in the study and the cyclical stocks. So probably the most important data point on this particular graph was the gain to the peak. And that's at the far right here. This first row is the growth stocks, and there were 134 growth stocks in the research study. And the gain to the peak, the median gain to the peak was over 300% gain. The cyclical stocks, when there were about 25 of those in the study, their gains were good, 172% median gain to peak, but obviously far less than growth stocks. So what we learned was simply that the growth stocks had much higher velocity, much higher pace in terms of gains per week than the cyclical stocks, though I don't think anybody would complain with a cyclical stock going up 172%. The question is, how difficult was it to hold a stock that might not be a growth stock? This comparison is looking at the colored chart is the 2021 bar chart for gains to peak. Maximum gain to peak, 1680. The minimum in the study was 106. And we compared that against other model book stocks that we've done. Here's the 2012 model book study. Here's our 2016 model book study. And here's the greatest winners study that I did a couple of years ago. Obviously, the greatest winner is the cream of the crop. So you can see gains to peak. And then how many weeks did it take to reach those gains in this particular bull market cycle? So this is just one peak. We did a lot of analysis versus previous model books in the full study. Now, another key analysis that we looked at, again, was the first 8 weeks. So we looked at the breakout for the particular stocks in the study, and then we really marked the 8-week marker because we're looking at this period that we have green flag stocks, and then we've also got Bill's 8-week hold rule, and we're trying to learn something from that. And in this particular diagram, one of the things that we looked at was the price action in those first 8 weeks. And we categorize things really in 3 different ways. The green line represents a stock that actually comes out of the gate very strong, and then it simply digests its gains and then makes its way onto the 8-week mark. So those are stocks that really digest gains. We also had stocks that broke out. They may have broken out very strongly, but they concluded a shakeout. They actually undercut the pivot point and they shook out. But those stocks also recovered and made 8-week gains and eventually made gains to the peak. And the third condition was this blue line where we had stocks that broke out, they held well, but they eventually came back to the pivot area. They revisited the pivot area without undercutting and then continued higher to 8-week mark, eventually median gains to the peak. So we're going to get into this a little bit more detail, but I wanted to give you these 3 categories because they're going to be important as we go through the research. We also looked at moving averages, and we looked at green flag stocks, and we looked at all kinds of combinations. We looked at green flag stocks that held the 10 and 20. We looked at green flag stocks that held the 10 and 20 and they had digestions. We looked at ones that had revisits, 10 and 20 held, and shakeouts. And you can see some of the median and average gains. And we've got a whole series of these analysis in the study. But we just wanted to give you the preview that we did study the moving average behavior in the first 8 weeks in a lot of detail. Now, this is an important slide to understand. This is called the initial run before we have the first 12% pullback. So let's go over what the initial run definition is. This is from the breakout. So when a stock breaks out, we're measuring the days from that pivot to the intraday peak high day before the stock has its first 12% minimum pullback. So as a stock makes its way up, has its first 12% minimum pullback, once we have that, we've marked this as the initial move. This is the initial thrust of the stock before it has its first intermediate term correction. And again, that correction needs to be a minimum of 12%. Any little corrections along the way of 3, 4, 5% we're not affected. We want to see the first meaningful 12% correction. And then what did the stock do out to week number 8? All right, I'm going to turn it over to Mike Kinkead, and he's going to take you through some of the ONeal Can Slim data.
Thanks, John, especially for those last 3 slides with those important concepts that we're going to be talking about. I just want to add, I've read all of Schwager's books, but if I know there are a lot of can slimmers on this call, but if you're not a can slimmer and you want to try it, the other book that you absolutely have to read just as strongly as Jason recommended the Wizards books is, of course, Bill O'Neill's How to Make Money in Stocks, and also subscribe to investors.com and Market Surge. Personally, as a position trader of growth stocks, which I've been doing for over 20 years, I could not invest in growth stocks without these capabilities. Next slide, please. So let's take a look. How did the 159, we call them super stocks or TMLs or model book stocks, how did they perform against ONeal's technical and fundamental criteria? Well, if you look at the box on the left, a whole lot of the stocks, most of them in fact, met ONeal's technical criteria, which the cutoffs that ONeal has, as you know, in Market Surge on the panel on the right. The one that was not quite as close as the rest was percent off the high. So only 71% of those stocks were 15% or less off the high. Now at the right, on the fundamental side, these stocks don't do so well relative to the ONeal criteria. So only 20% met the EPS rating cutoff. EPS change last quarter, only 48%, and sales change 20% or more, only about half. There's some other important criteria and some interesting things jump out. Earnings surprise, which is one of David Ryan's, he calls it one of the most underrated metrics. 61% of these TMLs had an earnings surprise that was 10% or more. 50-day average liquidity, we used a very low cutoff on purpose. You'll find out about that in a second. 10 million or more. Volume change on the breakout above ONeal's cutoff of 40, 57% of them. Composite rating, not so great. Only 64% of them had a composite rating of 80 or more. Next slide, please, John. So what can we take away from this? Let's look at bullet 3. Rely more on ONeal's technical metrics when a stock is starting its big run-up. Remember, these are TMLs, early stage. They're typically in stage 1 or 2 bases. That was in 96% of our study. Were stage 1 or stage 2 bases. And secondly, please don't use the unofficial IBD 50-day average liquidity cutoff of 100 million when you're looking at an early stage stock, because it would have eliminated 72% of the TMLs in this study and you would have missed a lot. Next slide, please, John. So now, as John said, we're going to do a deep dive into green flag stocks. Green flags, as John mentioned, are marked on the Market Surge charts. So they pop out at you when they happen. And they're important because of John's comment about Bill O'Neill's 8-week hold rule, which you all know about if you're can slimmers. Next slide, a little busy, but let's focus on parts of this at a time. So we're going to define, if you look at the top part of the table, we're going to define 2 different kinds of green flag stocks. And this is really important, and you'll find out why in a minute. True green flags hit and close in the green zone on the chart on Marcus Smith, which is otherwise known as the profit-taking zone, which is 20 to 25%, as you know, above the pivot. Soft green flag stocks only hit the green zone on an intraday high, and then they fall back and don't hit the green zone or profit-taking zone again until after the 3-week period. And Market Surge will mark either one of those 2 conditions with a green flag. Focusing on the table for a second, notice that slightly more than half, 55% of the stocks in the entire study are true green flags. 13% are soft green flags, and about 1/3 are non-green flag stocks. Next slide, please, John. So let's just look for a second at how the true green flag stocks do at the end of the 8-week mark. So they break out, they gain 20% or more in 3 weeks or less. And then the yellow line stocks, those are true green flag stocks that close 20% or more on day one of the breakout. In other words, the breakout day. And there were 8 stocks that did that. Their median gain was 34%. The next category is true green flag stocks that close somewhere in days 2 to 21. That gained 10% or more. And there were 61 names there. So that's 69 stocks out of 88. That's 4 out of the 5. Out of every 5 green flag stocks gain 10 percentage points or more when they hit the 8-week mark. And by points, I mean, if at the end of 3 weeks it had gained 30%, it gains another 10 if it gained just 10%. But often they're gaining more than just 10%. So by the end of the 8 weeks, a stock that hits 30% at the end of 3 weeks would be at a 40% gain at the 8th week. So I just want to make clear that we're talking about 10 percentage points or more, not just a 10% increment in the gain. And then we have 11 stocks that gained less than 10% when they got to 8 weeks, and another 9 that actually gained at a negative gain relative to their 20% plus gain at the end of 3 weeks. In other words, you would have lost a portion of your 20% gain in that last category. We thought that 10 percentage point gain at the end of 8 weeks was something that we really wanted to hold. If you want to follow the ONeal rule explicitly, then you would be holding everything. And of course, unless something goes terribly wrong with the stock, or unless something goes wrong with the market. Next slide, please. So with that data, what kind of insights can we draw from the analysis? So next slide, John. So as John mentioned, we're focusing on how green flags and non-green flag stocks, all the TMLs, perform 8 weeks after breakout, because that's, as John's going to point out later, the most challenging time when a stock is first breaking out in terms of you as a trader holding onto that stock and building enough cushion so that when it does have a pullback, you can ride through that pullback. So click, please. 80%, you've got an 80% chance of an additional 10% or more point gain by week 8 if it's a true green flag. And of course, if it's a soft green flag, you've got a 43% chance. And if it's a non-green flag, you've got a 28% chance. So the true green flags give you a really good shot at a substantially additional gain from 3 weeks to 8 weeks. So why do we want to distinguish between true green flags and soft green flags? And this is one of the big insights that came out of the study. John, next slide, please. Focus on the big green box in the lower left. The median gain for true green flag stocks at the end of 8 weeks is 53%, or almost double the 28% median gain for soft green flags. That is a really important signpost. So stock breaks out, it hits the profit-taking or green zone on a 20% or more gain. It continues up, and its initial run gain for true green flags is 45%. And then at the end of the 8 weeks, it's got a 53% gain, and at the peak of the run, a 304% gain. Click, please. As opposed to soft green flags, remember, that's the gray line. They go up and on an intraday high, they hit the profit-taking zone, but they don't close in it. They fall back, and then they continue their run. The initial run gain for soft green flags is 22%. And at the end of 8 weeks, it's 28. And then the gain to peak is 240. So if you've got a green flag stock that closes in the profit-taking zone in the first 3 weeks, and the good news is you're going to know, is this a true green flag at the end of 3 weeks? You've got a really high probability of a much larger gain at the end of 8 weeks. Not so with the soft green flags or the non-green flags. Next slide, please, John. This slide is busy. We're only going to focus on 2 parts of it. And it's using 2 of the concepts that John mentioned, holding, moving averages, and the behavior of the price action after the breakout. And let's zero in on the box in blue. At the 8-week mark, notice that the biggest gain has come from green flag stocks whose price action is digestion as opposed to returning to the pivot area or shaking out, that hold the 10-day moving average. So those are you're going to do really well, especially if you're not thinking of keeping this stock for the longer term run, which is typically about a year or so. Those are the ones that are going to do well by you. The one other thing I wanted to point out on this chart is the first pullback minimum. John mentioned that the depth that we use as our cutoff is minus 12%. Across all of the model book studies that we've done, that is such an the median is such an incredibly consistent number. 18%, 17%, 17%, 15%, all in the space of 5 to 7 days. That's how long the pullback lasts. So you can pretty much count on that median going forward based upon all the history that we've studied to date. John, back to you.
Okay, thanks, Mike. Let's look a little bit further at price action for the first 8 weeks. So conceptually, we're trying to understand, we get a breakout, and we've got the 8-week marker. And we've talked about there's a lot of action that happens in this 8 weeks. And we've been highlighting some of this, whether we have a revisit to the pivot, do we have a shakeout below the pivot, or do we digest? And we've also been noting where the green flag is, if it's true green flag, the peak of the initial move, and like as Mike just mentioned, the data around that first pullback, we have all the historical data. It's very, very consistent throughout bull market cycles. So why that's important is, well, 2 reasons. One, we know Bill's 8-week hold rule is designed to not get shaken out on the first pullback. And if you know the first pullback is going to be 16, 17%, you're expecting it. So you're positioning properly to hold through that. Doesn't mean the stock can't fail, but it definitely sets up expectations. So that's very important to know that pullback. And the peak of the initial move is where we start measuring that first pullback. So again, the goal is to really understand how to navigate the first 8 weeks to get through that, and then evaluate at the 8-week mark to say, should I hold this stock for a bigger gain, or should I take my gains and move on? Okay, why it's so important to understand this is because of the pullback. If we hit the green flag in 3 weeks or less, and we're trying to get out to 8 weeks, this little table is very helpful, because with the way the table works, it's saying take your gain that you have, and let's take an example of the blue stock here. The blue stock, let's say, is a very powerful stock. It's up 50% in the initial move. And if we'll assume on the table, you can pick what type of correction you want to plan for. If we use a 20% correction and a 15% gain, this table is going to tell you what your gain is reduced to. So a 15% gain, 50% gain, you correct 20%, your gain now is reduced to 20%, from 50 to 20. So you mentally have to, psychologically have to be prepared to give back gains to get to the 8-week mark. Obviously, if you have a stock that's only up 35% and it corrects 20%, your gains are reduced to 8%. That's not going to feel very good at all. And then if you think you're going to hold through something that's only up 20%, well, a 20% pullback, and you're going to be in the red. So this table is very helpful to understand when you get that first correction, how much gains do you need? And the table can help you understand planning for different types of pullbacks. So coming back to this concept of the initial run, we looked at the initial run and we looked at this first pullback. So we wanted to know, does the pullback occur after the stock has 20% gains, or does the pullback happen before we get to the 20% green flag? So we did an analysis looking at all the pullbacks that happened after 20% gains, and there were 112 names. And you can see here how these are easier to manage. You can say we've got the green flag. We continue to go up from 20% up to a median gain of these particular stocks, 48% in 5.6 weeks. And then we get the pullback that we're expecting. And in this grouping, it was an 18% pullback in 9 days. You can see that that's a whole lot easier to manage out to week number 8. You can see on this side, we've looked at all the pullbacks before we reached 20% gains, and there's 47 of those. And the initial run was only 19% in 1.4 weeks. But then with a pullback of 16%, you can see that most of your gains are going to be reduced significantly. So we took this analysis, and we're going to build upon this when Mike looks at some other data. But looking at pullbacks after 20% gains or before is an important marker. So this is just a quick example of a couple of charts from the study. This is Fastly, which you're probably all familiar with, big winner in the COVID bull market. This is a pullback after reaching 20% gain. So we can just take a look at this graphically. We break out. This stock actually hit the true green flag. It hit 20% on a closing basis on day 1. It continued very strongly. It was up 76% in the initial move in only 2.1 weeks. And you can see here, here's the first pullback. The first pullback in Fastly was 21%. So hopefully you're getting the visual of how that works. And here's an example of one that had the pullback before reaching 20% gains. Breakout in Fiverr. The initial run is up 22%. We get a soft green flag because the green flag was on an intraday price. So it was not a true green flag, and it pulled back 14%. And then you can see the true green flag on a closing basis was slightly higher, happened 11 days. So the importance is this is a big winning stock, okay? Both of them were big winners. But as we'll show you, the ones that have pullbacks after 20% gain are easier to manage. Mike?
Okay. So now we're going to introduce another concept. We wanted to look at which stocks in the TML study were easiest to trade versus those that are harder to trade. Next slide, please, John. So let's step back for a second. This is all stocks in the study, 159 of them. And you see that the initial run before the first 12% pullback is a median of 38% in 2.6 weeks. At the end of the entire run, the median gain is 274 to peak in roughly about a year. Note that in the COVID crash, if you look at the lower right side of this chart, 56% of the big winners or TMLs achieved the 20% or more gain in 3 weeks or less. Not on the chart. About 8 out of 10 achieved it in 5 weeks. Over 9 out of 10 achieved it by the end of 8. So by the end of the 8th week, most of the big winner stocks had gained 20% or more by 8 weeks. And then 100% of the big winners got 20% or more in 15. And notice that the first pullback, the median pullback in this study was minus 17% in 7 days, right in line with all the historical model books studies that we've done. But so that's the big picture of all the 159. But as Ken Slimmers know, not all of those stocks are easy to trade. So let's zero in and look at the criteria that we're going to use to determine which of those stocks are easiest to trade. Next slide, John, please. So let's focus on the 3 bullets on the left top side of this slide. There are 3 criteria that we used to define an easiest to trade TML. We want the first pullback to be after a 20% gain to the initial run peak. And that gives you the cushion to hold, as John was saying earlier. We want these easiest to trade stocks to hold the 20-day or 21-day, if you use it on market surge, exponential moving average in the first 8 weeks. And finally, we want the price action after the breakout to be digestion as opposed to return to the pivot area or a shakeout, because that creates pressure, makes you a little bit more anxious about holding on to the stock. So you can see that down in the table, 28% of the green flag stocks, or 1 out of 4, are easiest to trade. And 3/4 of them are harder to trade. So if you look at the data in the box on the right, using those criteria, the initial run is as a 52% median gain in 3.4 weeks. First pullback was minus 16% median in 6 days. At the 8-week mark, the median gain was 58%, and median gain to peak was 299 in about 51 weeks. That's 6% gains per week. That's power. So there are 38 of those stocks. Let's compare that to the other 121. Next slide, please, John. So this is just reaffirming what I had said earlier, that 1 out of 4 super stocks, the TMLs, are easiest to trade in the first 8 weeks. The harder to trade stocks, that's the big bucket of 121. Instead of having a 58% gain at the end of 8 weeks, they have a 33% gain. And on the initial run, same thing, 52% gain, much stronger than the harder to trade stocks of 30%. So we looked at this, and we were rethinking the analysis, because that 121 stock bucket is pretty big. Before we go to that, let's look at an example of an easiest to trade stock on the next slide, please. It's Twilio. Remember the criteria: pull back after a 20% gain, holds the 20-day or 21-day EMA, digestion of price gains. Twilio broke out on an earnings gap up, very strong breakout. It had a really nice, comfortable digestion of gains after it hit green flag status, as opposed to returning to the pivot area or shaking out. The first pullback happened where that red arrow is, right there, met the minimum criterion of minus 12%. Notice that the stock held the 21 or 20-day EMA in the first 8 weeks. In fact, it held the 10-day all throughout the fourth week, and then broke it. Our criterion there was, if a stock closes below a moving average, the next day we want to see that close stay below that moving average, not pop above it. And we want to see it undercut the low. So note that for Twilio, at the 8-week mark, and I apologize, there's a number, I'm going to give you a different number here. That 46% is what it gained from the pivot to the 8-week mark. It actually gained 36% if you measure it from the gap day close. So 46% from the pivot, 36% from the gap day close. Okay, now, next slide. We thought 121 is a kind of big bucket. There must be some really hard to trade stocks in that bucket versus ones that are just sort of hard. So we came up with some more criteria. So you've already seen the 38 stocks that were easiest to trade. You've seen that diagram on the left. On the right, here were the criteria that we use for hardest to trade. There were 34 of them. And the pullback could be either before or after the 20% gain, but they don't hold the 10 or the 20-day EMA. They do hold the 50, or they don't hold the 50. And instead of digestion, their price action after the breakout is they revisit the buy zone, or they shake out below the pivot. And there you see that the initial run median gains 22% in a slightly under 2 weeks. But the median gain at the end of 8 weeks is only 23%. And finally, the gain to peak is 289%. We're finding that things kind of even out when you get to the gain to peak for some of these stocks. So let's look at an example of a hard to trade stock that's not the hardest. So this is our third bucket. We've got easiest to trade, hard to trade, and hardest to trade. So this is, we call these stocks tweeners. And there, in this example, pullbacks after the 20% gain, it does hold the 20-day EMA and it revisits the pivot area. So you can see that it breaks out, it revisits the pivot, and then has a pullback. This is a true green flag, as was the earlier example. It holds the 21-day EMA in the first 8 weeks. And at the peak, 49% is from the pivot, but the green flag day close is 48%, so not much difference at all. Next slide, please, Sean. And now here is the hardest to trade stock. In this case, it's Magnolia Oil and Gas, one of the cyclicals. Its pullback was before the 20% gain. It doesn't hold the 50-day simple moving average, and it shakes out below the pivot. But that shakeout is after the pullback. So this one is really a hardest to trade. So you can see it breaks out, but it breaks out on high volume. That's a good sign. It's a soft green flag because it hits the profit zone on an intraday high only. The other two were true green flags. And then it has this first pullback before the 20% gain, which we're defining as the gain on the closing price of minus 16%. Then it has this gigantic shakeout. And as a result, when you get to the 8-week mark, and it's in round numbers, there are no additional gains. It's negative 17 for both the green flag close price and the pivot. They're both minus 17%. So this is not something that would be a whole lot of fun. So those are the 3 buckets that we wound up with when we looked at the data. We wanted to provide criteria that you could use to say, well, first of all, do I have a true green flag stock, which I know is going to be much more powerful? And secondly, do I have a stock that's easiest to trade? On the one hand, do I have stock that's hardest to trade at the other end? Or do I have a tweener that's going to be hard to trade, but nowhere close to trying to trade something like Magnolia Oil? John, back to you.
Okay, key signposts. So we've been sharing with you some of these metrics and pieces and parts, and we're calling these the signposts. And we've really created kind of the first 8 weeks, a number of signposts. And this is really the important piece to put it all together, because as the trade is unfolding week to week, there are things to monitor. And by monitoring those things to see if you're getting normal action or abnormal action, it's going to help you see if your stock really is one of the strongest model book stocks that's easy to trade, or maybe it's breaking down and not staying to form. So the 7 signposts that we've identified, obviously number 1 you're familiar with, that's the breakout. You want to see a very strong percentage gain. You want to see volume that's at least 40% or more, or even better, an earnings gap up. So that's our first signpost. What kind of a breakout? Is it powerful? The second part is what we've talked about at length, today, is looking if you're fortunate to have a stock that goes up 3 weeks or less, is it a true green flag or is it a soft green flag? Meaning true green flags closing price in the green zone versus intraday price is a soft green flag. So that's another signpost, because we've pointed out the data shows that the intraday high soft green flags don't perform as well. So that's a signpost. The third signpost is looking at the moving averages as week to week as we're moving along. Is it holding the 10 EMA? Is it holding the 20 EMA? We know that holding the one or that, particularly the 20, is very constructive, that you've got a smooth ride on your hands. The fourth thing is the price action. We talked about digestions, revisits, and shakeouts. We like digestion. Stocks that move up powerfully, but then generally hold their gains and go sideways is much stronger than revisiting all the way back down to the pivot. And certainly we would prefer not to be involved with shakeouts. So that's another signpost. The next piece is really looking at this intraday, the initial run and the first pullback. Is the first pullback of 12% normal? We know from the model book studies we've done, 4 of them, that the median pullback, and it's very consistent, is 16% in 12 days. So we want to say, is this stock staying true to form of a model book stock? This is another signpost to know if you have your hands on a real winner. And then obviously when we get to the 8-week mark, we want to take inventory of those additional gains from the green flag. We know that we have all the numbers from a closing price green flag stock to the 8-week mark. Those gains, we know what they should be, or at least the range of what they should be to be a really strong situation versus something that's weaker. So we have the 8-week gains itself. What is the total 8-week gains from the breakout? We have that data. And then at that point is when we need to evaluate. Once we get to the 8-week mark, and I think Bill says this in his teachings, you need to reevaluate the stock. You should say, is this stock have great gains? It's acting well. I want to come up with a new set of rules to hold it beyond 8 weeks. Or is it a stock that maybe is fading and maybe it's not an outstanding stock, it's a good stock, and maybe you just say, I'm going to take my 20, 30% gain and I'm going to move the money to a stronger situation. So the template is designed to read as things unfold, to understand you to be able to read what you may have on your hands for a model book stock. So here's an example of Tesla. We're all familiar with Tesla from the 2020 bull market, and I just put it through the signposts. What did it look like? Well, Tesla was tricky. Initially, had a 7.3% gain. The volume was not there initially. This is minus 3% volume. Didn't have that. So that's a little bit questionable. Then you'll notice that the stock actually pulled back to the pivot area fairly quickly, but it didn't undercut much. It did hold the 21 EMA, which is the purple line. So that was important that it held there. It actually held the breakout level. And you can see it actually reached green flag status. So it got off to a slow start, but then things really kicked in. It reached closing price, true green flag status, and then it surged. And actually, its initial move was 90% from the pivot. And then you can see here, we had the first pullback. Now, this stock was up 90%. That's one of the most high we have in the entire study. And you can see the pullback was a multi-stage pullback. It was deeper, 24% in 22 days, but it was after a 20% gain. And 24% is not unreasonable after having a 90% move. This stock has almost doubled. So we have a first pullback, and then we looked at the additional gains that we had from the gap day close, 29%. So we're measuring things as we go, and it held up really well. The 8-week gains were 56%. And as we all know that Tesla went on to be include more gains, and it was one of the biggest, a big winner. So that's looking at that through the signposts. And we've done this with some of the other stocks. And what we did as a test is, this is a stock from our previous model book. We took this concept of the signpost and the data we had gathered. We went back to the 2016 model book and we said, let's take one of the big winners. This is Weibo. Weibo gained 644% in 97 weeks. And we put it through the signpost to say, well, how did this do? Well, you can see the breakout was strong, 13%, massive volume over 400%, checks the box. Green flag stock, true green flag on a closing price, checks the box. The initial move was 30% before it had its first 12% or more correction. In this case, the correction was right in line with norms, 14.4% in 6 days. Very, very typical, telling us that this was really a model book stock. You can see also the price action. We had a digestion. After we had this gain, there was no revisit to the pivot. There was no shakeout. It was a digestion of gains, and it held the purple line, which is the 21 EMA. And I will point out, just to reinforce, you might say, well, geez, it broke the line there, John. Don't forget, our definition of a 21 moving average break is not a close below the line. The next day has no undercut of the first day. So there's no undercut. And these days here actually straddled the line. So there was no undercut of the prior day's low. So it held the 21 for the first 8 weeks. You can see the 8-week gains here. At 8 weeks, we had 55% gains. So the point is, the model, this signpost, held up well with the previous model book stock. So we've covered a bunch of information, but obviously we can't share everything in the study in 1 hour. So we wanted to let you know that we're actually going to do an offering to allow you to get access to the full deal. The study is over 200 pages. There's 300 graphic studies. We have the key signpost data template and what are all the key measurements to know. And we also, I personally have annotated 85 charts of these stocks. There's an example here. I've done all the daily charts. I've done all the weekly charts. These are valuable model book charts to have as precedents for future big winners. So we're going to offer the study itself, and we're going to do 3 webinars. There's that much material that we'll conduct a webinar, and we'll get into all of the things we've listed here to look at some of the more specific action. But most importantly, it'll be a live webinar. So people that attend can ask all the questions they want. We can have a discussion and get into the details. Webinar 2 is going to get into price action, weeks 3 through 8. We have even more data that we didn't have time for today. We talked about initial move and pullbacks, but we have a lot of data on 5 model book comparisons, lots of chart examples, and then Mike has done an AI discriminant analysis, which we'll share with you in webinar 2. In webinar 3, we'll get into the signposts. We'll take this template and we'll put that through the filters about, should I hold the stock? What do we do at week 8? We'll look at a lot of chart examples. And again, we'll take all your questions live. So it's going to be a 3-webinar series. You'll get the whole study. So it's a lot of information. We've shared a little bit today to kind of hopefully whet your appetite. There's all kinds of graphics and annotated charts. If you're interested in potentially getting the full study and the 3-webinar series, please send an email if you go to Rain King Insights/reports, you'll see a button that you can add your email. Just send an email there, or send an email to my rainkingbluebear@gmail.com. We'll get you on a list. We're going to issue the people that are interested the full study available on December 16th. We're going to give people a month to take and explore and tab this book and put your notes and questions in the book. And we're planning January to schedule 3 webinars that we just talked about. And we're also going to put together, Mike's going to put together, if you're brand new to Can Slim, we're going to do a 30-minute crash course video in basic Can Slim. So lots of material. There's lots more we wish we could have shared, but in this 1 hour, hopefully we've whet your appetite, and we do think we've got some really, really valuable things to share. Okay, so that's our presentation on the research overview insights from the 2020 to 2021 model book. So I think we have a little time for some questions, JT, if there are any. You're muted, JT.
That's unusual for JT.
Well, John muted me in the panel over there, thinking I wasn't muted already. I mute my microphone. All right. So Francisco had a couple of questions. He was talking about Lee Tanner uses a 14.5% decline from the peak for cell rule. Interesting, your study shows minus 17% and minus 12%. Can you elaborate on what rule would you use if applying one like Lee? And then on top of that, he said the life cycle trade authors use minus 30% to accommodate for base if a super stock quality conviction. Appreciate your insights on these. And if separating the data of true growth versus cyclicals, can you give a can that give you a different result? Gotta get these questions tightened up, Francisco.
Yeah, well, I think the one we can immediately ask is Lee Tanner's decline from the peak sell rule
Yeah.
is, I believe that's part of his big cushion sell rules.
Mm-hmm.
Don't forget, we're talking about stocks that are only 3 to 6 to 8 weeks out. So I don't think I would, don't quote me, but I don't think Lee's context is selling 14% from the peak on weeks 4, 5, or 6.
Yeah.
And then let's see, the soft versus true green flag, only the first day reaching the 20% within the 3 weeks is the valid signal, or the weekly close. Does that matter?
And we're using daily, right, Mike?
Yeah, daily close. But you're asking about what close we use to measure reaching green flag status. If that's the question, it's the daily close, and for in the green zone for true green flags, and the intraday high if it's a soft green flag.
Yeah, that was the question. All right. And then let's see. Here's one. One of the leaders of the Sunnyvale group concluded that after 100% gains, stocks took a breather. So, should you take gains around 100% and not wait? Is this supported by your study?
Watch the price and volume match. So we don't have volume in this study. That's a whole nother thing. We tried it, and we needed to step back and get some more finely tuned metrics on the volume side.
Yeah, I think when you do a study like this, and me and Mike did this, we actually studied the volume. What was it, 30 days before the breakout, 30 days after the breakout? We thought we would get some insights, and sometimes, you start these analysis and they don't lead anywhere. They don't give you anything meaningful. So we said you would probably need to look at it in a different way. So that volume query that we did not lead to anything. There were multiple things that we looked at that, didn't have any meaning. So when you do a study, you're seeing the things that did have meaning, which are worth sharing. But we were starting to study failed breakouts, and then that didn't really go very far. So, it's important to know when you do a research study like this, you don't just magically catch all the good things. There's a lot of false starts. There's a lot of things that you find out your premise didn't really have any meaning, and you got to be open to understanding that some things have no meaning.
Yeah.
And back JT directly to the question about the minus 100%.
Uh-huh.
So our cutoff for a true market leader, we said, look, any stock that's gained 100% or more during this rally period, we're going to call it a market leader, because that's a really nice, comfortable gain. It turned out, and we rejected stocks that had poor liquidity, that had gained, disastrous liquidity, that had gained 100% or more. We rejected bio stocks that had never made any money. And then we wound up with these 159 TMLs. But the range was 106 to 1680%. So minus 100, although we haven't looked at it this way, is an arbitrary cutoff. It's just watching the price and volume action of the stock as it goes through its full run up to decide what to do.
Okay. And then you already answered the question. So volume doesn't matter on that 12% pullback.
Right.
Okay. Let's see. And now are you seeing the same trends and returns in today's market as you did with these stocks you studied?
Well, that's an interesting question because there's a number of stocks that they hit green flag status, I'll say weeks ago, back in September or so. And so they're kind of in the window right now and they're unfolding. So we're, kind of monitoring them as they go. I know I'm looking at a couple of them saying, well, how's this doing? How's the stock doing? And there are some that are stronger, but this is how you'd use it. If once you have all the data, you're trying to apply it and trying to know which of these stocks is worth holding and adding to, and then decide at the 8-week mark if you want to hold even longer.
Okay. Well, there's a question about, could you talk about APP, Taser, Palantir, how to handle these 3 extended stocks to sell? That's not really a question about.
Yeah, actually, that's not really relevant to the study. We can't go on
Yeah.
a sidetrack on that right now. But ironically, those that are ranking insights member in my general market updates week, I talked about 4 extended stocks, and I specifically talked about how to handle the extensions. So I'll put in a plug. If you're not a basic Rain King member, you might want to be one. We talked about that exact question.
I say like APP is like 190 something.
Yeah, I went over it. Actually, I went over it in
Is it
APP in
200
great
now?
detail.
Okay.
Yeah, I went over it in detail in the video.
Oh, good deal. So there you go, Zach. Go sign up if you're not there already. And that's all I see.
Okay.
Mike answered what that dotted line was. So, yep, I think we look good.
Okay, great. So, just send us your email. We're going to compile an email list of anybody who has interest. We'll get you some more information. But if you're a can slimmer, there's a lot of good stuff here. And we didn't get to it. Like I said, that's why it's a 3-webinar series. There's so much information to share. And we want to have an opportunity to answer any and all your questions. So a lot of data to show. And not to mention, there's over 85 annotated charts that go through every big winner, which you can use as precedents for future big winners.
Very good. Good job, guys.
Thanks. So let me, I'm going to end this recording and we'll continue.